You know, Troy, I was hoping maybe to come back to you on this idea of, management risk or business risk more broadly. How have you guys tried to mitigate that with sort of this increased scrutiny by your investors?
Yeah, sure. I can offer a couple of perspectives on that. One would be the perspective of a firm that has to manage business risk associated with their management company. The other would be the perspective of an investor in hedge funds. We manage a hedge fund of funds. With respect to the management company, it's essentially blocking and tackling. It's applying tried and tested business techniques to the management firm. So it's managing a business instead of managing a fund. And we have found ourselves focusing much more on carefully managing the bottom line, going through a careful budgetary process, things like that. In terms of managing against business risk of the underlying funds we invest in, we've expanded our due diligence process. We now get very involved in the specifics of the management firms, so the firms that manage the products we invest in. So we find ourselves diving into issues like retention of key people. How are the key people retained at the underlying fund? How do we know these people aren't going to jump ship after we invest our money? What processes do they have in place to manage the risk of their management firm? So essentially, it's both sides of the same coin. It's just applying plain Jane, boring old business management.
Yeah. Anyone care to comment or piggyback?
Yeah, I was just going to say, when Kayne Anderson fields products, the question is, how do you sell that product to your investor? Do you sell it as a Kayne Anderson product, or do you sell it as a product that happens to be housed in Kayne Anderson? Over time, since we're such niche investors, we're not, global macro things. We're doing things like student housing and mezzanine and MLPs and oil and gas. The investor's really interested in what the product is and what the team that is delivering the product is. And they actually have a little bit of a problem that Kayne Anderson has such control over that. And so you have to figure out what value added you're doing at Kayne Anderson. And we become, in effect, the investment committee that often is duplicated by your investors. We do probably over 110 university endowments invest with us, and they always want to be on the investment advisory board. And we're actually trying to provide that same investment advisory board within Kayne Anderson. And if a portfolio manager starts to veer, or, one of the things we do at Kayne Anderson is we require every investment to have a massively complicated investment memo written under the concept that a PM can convince himself of anything if he's doing it in his head. If he writes it down, he can see the flaws of whatever logic he's doing, and if he has to present it to a third party, then it really crystallizes. And so the investment process is massively enhanced by this process. So then we've got to make sure we're delivering that process, because that's what we're telling our outside investors. So there's always the conflict of the PM on the one side and the investment committee, investment advisory board at Kayne Anderson, and how to maintain that is probably the big issue right now for Kayne.
Yeah, we started our life and have continued as a multi-product firm as opposed to a multi-strat firm, and that wasn't really by design. It was really a function of the people that the founders. And over time, a number of investors were critical, saying, well, what are you guys? And you seem to have a diffuse focus. And I've always thought that multi-products was a more stable business, because nothing works all the time. And investment ideas go out of favor and teams run into difficulty. And I think that the fact that we did have multiple products was really helpful over the last several years. And one thing that we did effectively is we brought in a mortgage team from Countrywide to start up a distressed mortgage strategy. And that was, of course, fairly timely, and there's a lot of opportunity there. And I think that helped us a lot. So, there's certainly, over time you make decisions, and sometimes in retrospect they're good, and sometimes in retrospect they're not so good. But I think that this multi-product formula that we have has really been helpful, and I certainly will persist in keeping on in that way.
Steve, how do you deal with the TCW problem?
The TCW problem, and what specifically is the TCW problem, Bob?
You enfranchise a guy, he goes out and does very, very well and decides he doesn't need you anymore.
I think that you have to, life's a negotiation, and you have to balance and keep, in a sense, recreating the financial relationship, and also provide benefits to being part of your organization, as you said. So, we provide compliance, finance, administration, business development, but it's certainly, in a sense, you're cultivating each of these groups and each of these managers, and you're constantly assessing what's kind of the fair distribution of revenues, really. So.
Well, the poor guy at TCW said, "You're paying me X, I can make 20X if I do a hedge fund."
Yeah, well, thankfully...
It's a bitch that we all have that problem. In franchising these guys, giving them their start, creating their client base, creating their track record, and then them deciding they don't need you anymore. That's one of the big issues we have.
Stephen, it sort of resonates with me, your comment on trying to keep employee morale up and things. Do you find that to be sort of the top sort of business risk you're looking to mitigate now, or are investors asking you guys to do other things?
Well, I mean, it certainly is. I mean, I'm a portfolio manager, so my role is much more in the sort of day-to-day management of the strategies and the development of the ideas behind the strategies. So, I mean, morale is certainly something that we are seeing is an important issue, but I don't know that's necessarily the one that I'm most closely involved in. I think just kind of a general thought on responding to what's happened over the last couple of years. I'm actually fighting a little bit against changing too much in response. You hear about what are you doing now? What are you doing now because of what's happened over the last 2 years? How are you changing your process? And you hear this time and time again, not only internally, you hear it externally from clients and prospects. And I actually have a little bit different view on it, and that is that I don't think you want to make major investment policy decisions going forward based upon what's happened the last 2 years. Should you consider what's happened the last 2 years in your investment process and your risk control? Absolutely. But what we've gone through, in any statistical sense, is such an extreme event. I think the likelihood that we're going to see something like this again in our lifetime is relatively low. But people are so conditioned to respond to what's happened recently. They look at right in their rearview mirror and they assume that what's happened yesterday is going to happen tomorrow. And I think making policy and investment decisions based upon this extreme window of time we've gone through could actually be a very big mistake. We should consider it. We should take it into account in our risk budgeting. But the last thing we want to do is make decisions from an investment standpoint, assuming that the world going forward is going to be like it has been over the last 2 years.